This is what you've been waiting for. The 2,000-pound elephant has just entered the room. How do we pay for all this stuff? To honor our time commitments to you, I am going to touch on four major topics, and we are going to skip over a couple of slides. But to very briefly answer the question of who's going to pay for this or how is it going to be paid for, let me answer that very briefly. 48% of it will be paid by individuals, primarily higher income individuals, through increased taxes. And the other 52% of it will be paid through fees, not taxes, fees, but they sure look like taxes that you'll see, that will be assessed to insurance companies and against self-insured plans and against pharmaceutical companies. And we can expect that those fees are going to flow through to the plans and that those fees are then going to be reflected in increased premiums. The first tax that I'd like to address is the new Medicare health insurance tax. This becomes effective January 1, 2013, and it affects individuals who have wages or self-employment income. So this is your earnings from employment or what you do. The tax that is imposed is based upon the trigger for the tax is based upon your earnings. If you're filing an individual return, the threshold is $200,000. If you're filing a joint return, the threshold is increased to $250,000. And then for earnings that you have in excess of that applicable threshold, there is a 0.9% health insurance tax imposed on those earnings. Those earnings are already being subjected to the Medicare HI tax, and this is an additional tax over and above that. Now, one of the interesting things about this is this tax, unlike the Medicare HI tax that we've been used to for a number of years, is not imposed on the employer. There's no employer matching tax. This is on the individual only. However, it is the employer that is responsible for withholding this tax. So the employer which determines that they have an employee who is probably going to file a single return needs to start withholding this tax when that employee starts at $1 over $200,000, or if it's been represented that that employee is going to file a joint return once that employee goes over $250,000 of earning from that employer. Now let's say we have a married couple and one is earning $100,000 and another is earning $175,000. That couple is going to be over the threshold. Neither employer is required to perform the withholding. The next slide illustrates the amount of tax that will be imposed. As you can see, at $250,000, there is a $450 tax that's imposed upon an individual, no tax on a joint return couple. And this $450 difference continues throughout the application of this tax on into infinity. The next tax is perhaps more concerning because it is a higher tax. The rate of tax here is a tax imposed at the rate of 3.8%. And this is a tax imposed upon unearned income. This is a tax that's imposed on dividends, on interest, on rent that's received where you're not an active participant in the rental program. It's imposed upon annuity payments. There are a number of areas that this tax does not apply to. The tax does not apply to tax-exempt interest that you receive, municipal bond type interest. It does not apply to royalties and rents where you're an active participant in that business, and it would not it currently does not apply to distributions from qualified retirement plans. However, there is already talk of changing that exemption for distributions from qualified retirement plans to making those distributions taxable under this additional 3.8% tax, which argues in favor of, for those of you who have IRA accounts that could be converted to Roth IRAs, to make that conversion. This is an additional incentive to make that conversion because distributions from Roth IRAs are not taxable, and that is not on the board for consideration right now. Again, the specific thresholds that apply for the imposition of this tax are for unearned income that are above designated dollar levels, the same dollar levels as we mentioned just before. And you can see the application of this tax on the next piece in the handout. As you can see, this becomes a very expensive tax once it applies. And you'll notice the ticket that's expected to be generated by this tax is $123 billion over the next 10 years. A lot of revenue is expected here. Please note that you could be subject to both the 9% tax on employment earnings and this 3.8% tax on unearned income. And let me give you an example where you might think we're not over either threshold. For example, an individual has $190,000 of wage income and also has $20,000 of interest income. So that's a total of $210,000 adjusted gross income. The 3.8% tax on unearned income applies to that last $10,000. So in the stacking of income, we put wages in first, then we stack on the unearned income, and the unearned income that would take us over the threshold, that gets taxed at 3.8% in this example, where it would appear that the individual is not over either threshold. The other two sources of revenue for this, these fees are imposed upon health insurance. And it does not apply to accident, to disability, to Medicare supplements. It does not apply to long-term care insurance. It also does not apply to benefits provided under a self-insured plan. This is a tax that's imposed upon insurance carriers. And the tax imposed on each carrier that is subject to this, that's selling health insurance, is determined by their market share. And there's a very sophisticated formula for determining market shares of different providers. These fees are not deductible by the insurance companies. So in reality, they are a tax. And these fees are going to flow through to the plans that are insured, either individuals or to the employer plans that are insured. And we're looking at a tax estimated to raise $112 billion worth of additional revenue over the next 10 years. Yesterday, it was announced, well, I should say, I thought it was going to be approximately $11 billion a year that was going to be imposed upon the insurance carriers, that getting us to the $112 billion over 11 years. Yesterday it was announced that for the first year, the fees that are going to be imposed are $8 billion for 2014. Then for years 2015 and 2016, it's $11.3 billion. In 2017, it's $13.9 billion. In 2018, $14.3 billion. So you can see what the trend line is, and if that trend line continues throughout the next 5 years of the projection, it's going to produce more than $112 billion worth of taxes. Let's face it, these taxes are going to flow through to the covered plans. Other major source of revenue is in the area of taxes on pharmaceutical companies. I'm sorry, fees. The Act contains a new set of fees that are imposed upon certain pharmaceutical companies. And the tax or the fee is determined based upon the amount of revenue that they receive from Medicare, VA, and the Department of Defense in connection with the sale of branded drugs. And again, expect that those fees by those providers are going to be passed through to the plans. Well, there's an obvious conclusion here. One of the things that you should be doing in terms of planning is encourage the use of generic drugs, because if your plan subsidizes the cost of branded drugs, it's going to be the branded drugs that carry this cost. So that's one of the obvious approaches here, and that's what I'd like to close with is what are some of the things that you can be doing in order to minimize some of these adverse effects. These are the big ones, and these are areas where you may be able to do something. First of all, as an individual, if you're subject to the threshold of earnings in excess of the $200,000 or $250,000 adjustable gross income threshold for the 3.8% tax, increase your tax-exempt interest so you don't pay the tax on that. And as I mentioned, you may want to do a Roth conversion because it appears that qualified plan distributions, including traditional IRA distributions, may be in the crosshairs of becoming subject to this additional tax. For plans that are either not self-insured or partially self-insured, you'll be working with people like Brett to determine, would it make sense to increase the amount of self-insurance in these plans so that we can reduce a number of fees that are applied to individual plans. As I mentioned, encourage the use of generic drugs in your plans. That's, again, going to help hold down costs. One item I did not cover, which I would like to just mention in closing, one of the benefits of this plan, this is not a tax, but a benefit that if for employers that have self-funded plans that provide retiree medical coverage for persons who are age 55 through 64 during the period of June 22, 2010 through the end of 2013, there is a subsidy that is available under this act to help you pay the premiums for individuals who are in that area. And if you're in with an employer that may go through a RIF and you're offering bridge insurance coverage to people who are between the time they're let go to Medicare eligibility, or if you're with a employer that has a, let's say, a union negotiated plan that has this kind of benefit for early retirees, you need to apply for this benefit. It's only for these 3.5 years, and there is a limited amount of money that's available. You have to do it through HHS. We'd be happy to help you as soon as HHS tells us how to do that. And with that, I'd like to turn it back over to Bob.